Hi everyone. So welcome to the stream today. Very much excited to have you. Having some technical challenges here, so couldn't join the stream as early as I'm supposed to join, and still we've not been able to resolve it in relation to that. So I'm just going to be coming with you here, and it's going to be a Q&A session. So whatever questions you have, put it in the chat box for me, and then let's discuss it in relation to that. Victor Droko, I see you. You are welcome. MCA, hello, thank you, sir. You are welcome. Samuel Kwasin, hi. Laura Nkwebo, I see you. Nkwebo, sorry if I pronounce your name wrong. It's great to learn from you again. It's always a pleasure. Give us a thumbs up on the video. Whatever questions you have, put it in the chat box for me. Going to be answering all of your questions for you. So, do you have any questions for me? Put them in the chat box and then let me reply all of your questions for you. So we're going to be doing a Q&A session today. Patience, I see you. I didn't hear from you, Patience, on Friday. What happened? I hope you are doing well and you are studying as well for your exam. Nana Apia Kubi, you are welcome to the stream. Hi. Okay. So, any questions for me? This is going to be a Q&A session. We plan to do budgeting and budgetary control today, but we couldn't. I will not be able to do that today because I had a problem with a couple of issues here, so I couldn't. I will not be able to do my lectures directly in relation to that, and my setup is not configured for me to write for you to see well in relation to that. So I'm going to be taking some questions from you today in that case. So whatever questions you have for me, let's chit chat, put it in the chat box, and then we're going to be looking at it. Kwame King said your videos have been very helpful. That is great to hear, Kwame King. That is very, very great to hear. Thank you very much. So questions for me in the chat box. Any questions you have that you want me to talk about, put it in the chat box for me and let me share some issues with you in relation to that. Okay, so MCA said, let's do balance scorecard, sir. I have a video on balance scorecard already on the channel. We released a video on balance scorecard where we are assessing the organization's performance from the four perspective by Kaplan and Norton. And I think you can watch that video on the channel. It's available already on the channel. So I may not talk about it that much in relation to that because we already have a fully complete video on that, so that I can maybe answer a couple of specific questions that you guys have in relation to that. So if there are any questions that you have, Sandija Irisa, okay. Sorry if I sabotage your name, forgive me, okay. It was not intentional for me to mention your name wrong in that case. So let me know how is studies going for you guys. Zolak, hi sir, thanks for your videos. It's a pleasure, Zolak. I hope you are studying and working hard for the exams as it is coming up any moment from 13th of July in that case. So whatever questions you have for me, what is it that you want me to share my thoughts on, areas that you have difficulty in that you would want me to talk about, something specific in that case. Then Erisa said we are on, watching and noting. Okay. Let me open my chat app so I can see you here. Seidu, I see you. You are welcome to the stream. So let me know in the chat box, how is studies going so far? We have 28 days to go for the ICA examination, 28 days to go. How is studies going? And then what do we do? What questions do you have for me? Let's look at that. Okay, I see a tall list of questions coming in there. Let me look at that real quick. Laura Nkwebo said, a lender quotes an interest rate on loans at 22% per annum with continuous compounding, but interest is actually paid quarterly. Find the amount of interest on the loan of $250,000 after 1 year. Okay. So you asking me the question to solve for you, I guess. Zolak said, it's a pleasure to. Is this season for a particular level or, sorry, is this session for a particular level or all level? This is a Q&A. I'm actually supposed to have done budgeting today, but we had a technical issues with our setup here, so we couldn't take that in. So I'm taking a Q&A. So you can actually throw me the question from any level, any subject, and I'll be able to provide you with some answers. All right. So Zolak, you can bring in any questions that you have in relation to that. Okay, so let's come to Laura's question. He says a lender quotes an interest rate on the loan of 22% per annum with continuous compounding, but interest is actually paid quarterly. Find the amount of interest on the loan of $250,000 after 1 year. So this is a compound interest question in relation to that. Unfortunately, I will not be able to write today because if I write, it's going to be a bit inverted. So I may have to just talk about it for you and provide you with a guideline on what you're supposed to do in relation to that. So since we have looked at the initial value of 250,000, and the loan is paid, interest is paid quarterly. So how many quarters do we have in a year? 4. So the period of compounding is going to be 4 in relation to that. So if you are looking for the future value of those 250,000, your end is going to be 4 period in that case, and then you apply your 22%. Then once you get a future value, you can now be able to get the amount of interest that you are supposed to pay by taking the 250,000 out of that in that case. Probably I may illustrate this tomorrow once we are set with our technical issues, so I can write, then you'll be able to get it in that case. So I've actually taken a screenshot of it, Laura, so that I can look at that for you. So any other questions? How is studies going? How are you preparing for the exams? Have you identified some areas that you have weaknesses with that you would want me to talk about? Or is there any specific issue that you would want me to mention? I see a comment from Erisa. Let's see that. Hello, how is sale and leaseback transaction initially recognized in the accounts and its meaning? Okay, ERISA, I have a full video on leases already on the channel. I have like 5 different videos on IFRS 16, and you can watch that later on, but I'm going to actually answer your questions for you. Now, sale and leaseback depends on whether the transaction actually fulfills the IFRS 15. Now, if performance obligation is satisfied, meaning the transaction is sale, in that case, what happens is that the seller, who becomes the leasing or the lessee, will be derecognizing the assets. Okay, he will derecognize the asset, then at the current value definitely, then he will recognize a lease liability in relation to the leased asset, then he will also recognize a right of use of asset. But the standard states that the right of use recognizable should be the percentage of the previous carrying amount retained. So in the books of the lessee, who is the seller, he's going to be derecognizing the asset if it is a sale. Performance obligation is satisfied. Then he will recognize a right of use, and then he will also recognize a lease liability in relation to that. Then the final thing is that any gain or loss on the rights transferred is in the books of the lessee. Now, the buyer, who becomes the lessor, since the performance obligation is satisfied, he will now recognize the asset and account for the asset in accordance with any accounting standard in relation to that. So once he is leasing it back to us, he will be applying IFRS 16 lessor accounting for the lease in that case. But assuming performance obligation is not satisfied, okay, then it means the transaction is not a sale. So if the transaction is not a sale, it means the transaction is a financial arrangement. So in that case, the lessee, who is going to be the seller, will be still recognizing the asset. So he will not derecognize the asset, but rather will recognize a financial liability being the proceeds or the fair value received under the lease in that case. Now, the buyer, supposed buyer, since performance obligation is not satisfied, the buyer will be recognizing a financial asset in accordance with IFRS 19. Did I say 19? IFRS 9, financial instruments, or IAS 32, financial instruments, disclosure and presentation in that case. So ERISA, this is how sale and leaseback works. All right, this is how sale and leaseback works. Like I said, I have about, I think, 5 videos already, or yes, some videos already fully on the leases, and so you can watch that as well to be able to get the full understanding on this one. But basically, with your question, that is what we do. Okay, so Laura said thank you. And then ERISA said, good sir, I will also visit the videos. All right, that is awesome. So if you check the channel page, you see the accounting standard series. That is the playlist, and then in that playlist, you will be able to get access to the content on that. Ebenezer Atta, I see you. You are welcome to the stream. Any questions for me? There's a Q&A session, all right? Originally, I'm supposed to have be lecturing on man accounting, but unfortunately, we cannot do that because our technical setup having a problem here. So we need to skip that, but I cannot cancel because, Charlie, I miss you guys. I need to come and then come and answer some questions from you and provide you with some strategies as well. So we're going to be chit-chatting in that case. So we are just chatting. Put it in the chat box, whatever questions you have for me, and let me answer them for you. So what subjects are you writing, and then how is preparation going so far? Now, one of the things that you need to understand basically in order for you to position yourself to pass the examination, it's to decide that you want to be the best at the end of the day. All right? So for those of you who are thinking that, oh, Nhyira, I just want to pass the exams, I just want to pass the exams. No, that is not enough. It's not about just passing the exams. It's about putting in the effort, all right? It's about working hard. It's about sacrificing. It's about having a timetable. It's about giving in your best, because we have only 28 days. And some people are panicking. I've not learned anything. No, you have something already. You need to look at it as the cup being half full rather than being half empty in relation to that, because definitely you know something already, okay? You know something about the subject, you know something about what you are learning, but probably it's not formidable as it is supposed to be, but that doesn't mean you give yourself out in that case. So I see a question from Zolak. Let me see that. Say, how is the investment in an associate treated in the consolidated financial statement? Okay. Now, Zolak, when it comes to the treatment of investment in associates, we use the equity method in accordance with IAS 28, investment in associate. Now, if we are preparing the consolidated statement of financial position, then we are going to be applying the equity method by bringing the cost of the investment, adding or subtracting profit or loss from the associate, lessen any dividend received, then the carrying amount is what will be taken to the statement of financial position in that case. If you are preparing the consolidated statement of financial position, rarely there may be impairment in our investment in associate. If there are impairments in our investment in associate, that will also be deducted. So you bring the cost of the investment, you bring the share of profits from the associate, then you less any dividend that you have received during the year, then we also less any impairment. If there is impairment in our investment in associate, then we less that. After that, we're going to be getting the carrying amount. So that carrying amount becomes what? The value we take to the statement of financial position. But if we are preparing the statement of profit or loss, that is the consolidated statement of profit or loss, then the only thing we will be thinking about is the share of profit. Because, okay, it's a share of profit. So after your gross profit on the face of the consolidated statement of profit or loss, you bring share of profits from the associate. Okay, share of profit or loss from the associate. So that is how investment in associate is accounted for in the consolidated financial statement. Zolak, does it make sense? Mohammed Sakib said, thanks, sir. You're welcome. Erisa said, hello, also an overview of deferred tax. Okay, Erisa, I also have a full video on tax, all right? I have a lot of videos on tax as well, but let me give you the overview of that real quick. If you join the stream, you have any questions, put it in the chat box. It's a Q&A session, all right? It's a Q&A session. So drop your questions for me. I was actually supposed to teach functional budgets today, but we have a problem with our setup, and somehow it wasn't clicking, it wasn't connecting to YouTube. So they are working on that, and we'll be back tomorrow for that. But I said, hey, I still have to come and then have the discussion with you, because if I can't teach live, that doesn't mean I can't interact with you guys. All right, so that is why I'm here. So it's going to be a Q&A session, as you can see from the title. So whatever questions you have, put it in the chat box for me. I'll be very much grateful to answer them for you, so you can prepare for the exams. So Zolak said, well received. All right, Zolak, that's awesome. Zolak, I also have some lecture videos on group accounting on the playlist, on the channel page. You can check that out. I broke down the principles on consolidated financial statement from goodwill, net assets, NCI, group retained earnings, and all the principles, intra-group trading, all of those things. It's already available on the channel. So in case you want a further understanding, you could go that as well in that case. So Erisa said, overview of deferred tax. Now, deferred tax come to being in relation to finding out the future tax consequence of transactions that we are having today. So what is the future consequence of that transaction is what we refer to as the deferred tax. Now, deferred tax can either be on assets, it can be on liabilities, it can be on investments, it can be on various issues in relation to that. But the idea is simply that when it comes to transactions and assets, the way it is accounted for by the tax authority is different from the way it is accounted for by the entity. For instance, let's say property, plant, and equipment. The entity will be depreciating the property, plant, and equipment, and hence will be carrying the property, plant, and equipment at its recoverable amount or at its carrying amount in the statement of financial position. But the tax authority doesn't carry the asset, that same asset, in their books at the carrying amount or at the recoverable amount. Rather, the assets will be carried at its tax base. So whilst the entity is dealing with depreciation, revaluation of assets, the tax authority is dealing with one thing and one thing only, and that is capital allowance. So we need to get a tax base of the asset, and that is going to be the cost of the asset minus the capital allowance. Then we compare that with the carrying value of the asset or the carrying amount of the asset, which is going to be the cost of the asset minus accumulated depreciation. So at the end of the day, there is going to be a difference in the value that the tax authority has in its books concerning that particular asset and the value that the entity has in its books concerning that asset. The difference between these two values, that is the tax base of the asset and then the carrying value of the asset, is what is referred to as the issue in relation to temporary difference. Now, this temporary difference can be positive or can be negative. If the temporary difference is positive, it means that the carrying value of the asset is greater than what? The tax base of the asset. Technically, what it means is that going into the future, the entity will be paying tax liabilities. What does that mean in practice? This is what it means. If I'm carrying the asset in my books at $50,000, and then the tax authority is carrying that same asset at $35,000, should I sell the assets today at $50,000? If I'm filing my tax returns with the tax authority, in the tax authority book, it's $35,000. So the extra $15,000 is a profit I'm making, and on that $15,000, I'm supposed to pay tax. That is how deferred tax comes in. So for us to get a deferred tax, it is the temporary difference multiplied by the tax rate. And like I said, the temporary difference can be positive, which means your carrying value is greater than your tax base in that case. So it results into a future tax liability, hence it becomes a deferred tax liability. But the reverse is true. And what is the reverse? The temporary difference can be negative. If the temporary difference is negative, it means that the tax base of the asset is greater than what? The carrying value of the asset. In that case, it means when we sell the asset, when we dispose of the investment, we're going to be making a loss. For that reason, the tax authority will refund us, will credit us with some tax relief, and that is going to result into what is called deferred tax asset. So ERISA, when we talk about deferred tax generally, this is what we mean by deferred tax. Does it make sense? Okay. Any other questions? Put it in the chat box for me. Erisa said Asante. Okay, so it makes sense, sir. All right, that's great. That's great. That's great. Any other questions for me? Any other questions? Put it in the chat box for me. Put it in the chat box. And let me answer them for you. This is a Q&A session, all right? So Nhyira is not going to be talking. I'm going to be talking in relation to your questions. All right. Now, so as I wait for some questions, let me also talk about this. We have some people still calling us concerning our asking about intervention and those things. Like I mentioned last week, I don't do intervention, or we don't do intervention. We have our executive revision masterclass, and that is exclusive for our students, both on-campus students as well as online students in relation to that. So we don't do any intervention class solely, exclusively for our students for our executive revision masterclass. So some people are still calling and asking about it. It's rather unfortunate, but we don't do an intervention class, and our revision session is not open to the public, but strictly for our students in that case. So that is also something that I need to repeat. I said this last week, but still people are calling and asking about it. So the thing is that if you want to be part of our revision session, you should be our students, all right? You should be part of our students, and that is it. Because the reason why I don't do intervention is this, because many people hide behind that, wait for a long time, and 1 week to the exams, they want intervention, and they are coming in and they are going to be talking about a lot of things, and you are saying this, they are saying that, that kind of thing. So I realized that it wasn't something that is for me, because I would want to rather spend time with the student that I've been with for the past 4 months and or 3 months, and deal with their issues on the practical level, provide them with that assistance, give them that a personal level in that case, to be able to help them in that. So that is why we don't open our revision sessions for the outside, and I also don't do intervention class in that case. So I see some comments coming in. Sweet Samba said, where do you hold your classes? We are located at Dakoman, near Dakoman Station, Accra. So Dakoman, near Dakoman Station. You can call us 050-114-9296. 050-114-9296. I've left the number in the chat box as well, so you can cross check. 050-114-9296. You can call or WhatsApp that number for any further inquiry, but we are located at Dakoman, near Dakoman Station. We have the courses also available online, so there are a lot of students also studying on our study portal, joining our Zoom sessions, and also having a one-on-one session with me in that case. So not only on campus, we have also the online portal where students are learning for the May 2020 exams as well. Nimatu Isifu said, please, overview of diluted earnings per share. Okay, that is great. Let me talk about that real quick. Now, I don't think we have a video on, I can't recollect though, but I'm not sure if we have a video on earnings per share on the channel. Joycelyn, can you check that for me? So, when it comes to diluted earnings per share, this is what is happening. Diluted earnings per share, it's trying to bring the future to the present. For instance, when an entity issues a convertible loan note, what it means is that on the date of conversion or on the date of redemption, when the loan is due, the stockholders could decide that, hey, we don't want our money, we want some part of the cake, we want to be shareholders, so they can convert into shares or they can take their money. Or an entity in order for them to, or an entity in order to motivate its employees, especially the top executives, there is something that is called in management the golden handcuff. So the entity will provide the management with what is called share option, which simply means that should you work with us for the next 5 years, you will be given rights to buy shares in that case. Now, are these things due? No, they aren't due. The bondholders are not ready to convert. The management is not also ready to exercise their rights on the share option. But we are going to assume that if they had converted now, if they buy the shares now, what will be the implication of that on the earnings per share currently? Are you getting it? Because should the bondholders convert into shares, it means the number of shares will go up. Now, if the number of shares go up, it means that there will be a reduction in our earnings per share. So the diluted earnings per share concept is trying to inform shareholders that today you may be earning $2 per share, but next year or next 2 years, should the convertible bond convert into shares, your $2 will become $1.2 in that case. So that is the idea about the diluted earnings per share. Now, when you are dealing with a convertible loan notes, because we are assuming that they are converting now, what is going to be happening is that, you know, on convertible loan notes, we pay interest. So we will assume that we are not going to pay the interest. So the profits for the year will be adjusted by adding back the interest that we should have paid and lessen the tax interest, because you know interest is tax deductible. So we are going to be adjusting our profit for the year, adding the interest, lessen the tax effect on the interest, and that is what we're going to be using to calculate our earnings per share. Then the weighted average number of equity shares will be the outstanding share for the year plus the number of shares that the stockholders will get on the conversion of the convertible loan note. So that is how we deal with the convertible loan note. If it is a share option, there is no need for us to adjust the profit for the year. Why? Or profit attributable to equity shareholders. Why is there no need for us to adjust? Because the share option has no implication in the statement of financial performance or in the statement of profit or loss. So all we do is that we need to go through a certain procedure by calculating the percentage of dilution, taking a percentage of that on the share option to get a number of shares. Then we will add that to the shares outstanding to get a weighted average number of equity shares in that case. So Isifu, when we talk about diluted earnings per share, this is the concept about that. Does it make sense? Let me know if it is clear. If it is not, indicate where it's not too clear, then I can come in as well. M. Saidu said, please explain how dividend is treated under group accounts. Now, dividend from who? Is it from associates or dividend from subsidiary? Saidu, clarify that for me and let me see where I can put you well in relation to that. Isifu said it's clear. Thank you. You are welcome, Isifu. Any questions, put it in the chat box for me. Prince Anna said, sir, please, do you have videos on single entry and incomplete records? We currently don't have like videos publicly available on the channel, but that is part of our online course. In that case, it's part of our online course, financial accounting. So that is not available now on our YouTube channel, but it is on our study portal, our full course that you can get in that case. So it's not available like for release, but it's exclusive for our online portal. Alpha Kenny 1. Were you asking a question? I see that your message has been retracted. So if you can restate your question, something like that, I'll be able to answer. Saidu said, please illustrate both scenarios. Okay. I think I said this a moment ago. Maybe you were not around then. Now, when it comes to investment in associates, the way we account for investments in associates is according to the equity method using IAS 28. You know already. So we bring the cost of the investment, we add or subtract share of profit from the associate, then we are going to be lessen any dividend that is paid. So if you are preparing a statement of financial position, then that dividend received will be less. Okay? That dividend received will be less in relation to that. Okay? I hope you get a concept. Will be less. Then the net figure will be taken to the financial position. But if we are having the subsidiary, how do we treat the issue about the dividend in the subsidiary? This is what you need to understand. When we are preparing the group retained earnings, that is, if the examiner asks us to prepare the consolidated statement of financial position, when we are preparing the group retained earnings, we will bring share of profits from the subsidiary and add it. Then the dividend that we receive from the subsidiary will be deducted in that case. Okay? Will be deducted. So that the net figure will be what will be implied on our retained earnings or group retained earnings in relation to that. So Saidu, that is how we do the treatment for the dividend in group accounts. If it is an associate, you deduct it in getting your carrying value to the statement of financial position. If it is a subsidiary, you still deduct it in the group retained earnings after you add share of profit to the group retained earnings, and then the net figure will go to the statement of financial position. Does it make sense? Any other questions for me? Saidu, let me know if it makes sense or where you don't understand, then I can retouch on it for you. So if you join the stream, whatever questions you have, put it in the chat box for me. Want to answer your questions for you. Okay, so Sadie says it makes sense. All right, that's awesome. Any other questions? Put it in the chat box. Any other questions? Put it in the chat box for me. Let me see if I have missed any chat. Okay, so we're done with that. Olakunle Falabaki. Forgive me if I don't mention your name right, okay? He said, can you please explain the fundamentals of portfolio theory and risk management? That is a whole thing on its own. All right, so let me see if I can touch on a couple of things in that case, especially this one has to be more writing issue, but let me see if I can touch on a couple of things verbally in that. I have lecture videos on this on the channel. Let me illustrate that to you. Let me show that to you and then, sorry, let me tell you about the playlist. So you check understanding financial management. That playlist on the channel, understanding financial management. That playlist, as of today, we have 44 videos in there, and it has lecture videos on portfolio theory as well as risk management. So I did a whole series on risk management, a whole series as well on investment appraisal, and then there was portfolio theory coming in there in that case. So I think the whole playlist there will help you for that. But when it comes to the issue about risk management, usually I need to even contextualize what kind of risk management you are talking about here. Are you referring to financial risk management like interest rate risk, foreign exchange risk, or you are referring to risk management as in project management or other things? Please clarify your risk management, then I could answer you better. So Olakunle, is it about treasury risk management like foreign exchange currency risk management or interest rate risk management? Is that what you're talking about here or something else? Kelvin Kamara said, can you please do a quick review on intergroup trading in consolidation? Okay, Kelvin, I will explain that to you. But when you finish, after the broadcast, go to the channel page and look at the playlist titled Group Financial Statements. As of today, there are 25 videos there, and I did a short pieces videos on all of these elements. Group structure, intragroup trading, net assets, and you can watch those videos on the channel, okay? So Kelvin, that will help you for you to understand the whole issue. But I will try to answer this question. So when it comes to dealing with intragroup trading or intergroup trading in consolidation, we need to identify what is coming out and what kind of financial statements we are preparing. So one, if we are preparing the consolidated statement of financial position, if we are preparing the consolidated statement of financial position, then that is going to mean that there is a way we need to treat the intra-group trading. Number one, if one entity sells to the other, so let's say the parent sells to the sub, and at the end of the accounting year, the sub still has some of the inventories in stock, then it means that the sub is carrying the inventory at its market value, which means the cost plus the profits the parent added when they were selling. But since we are preparing the financial statement for the single entity as one entity, we need to carry the inventory at what? Cost. Lower of cost or net realizable value. For that reason, when it comes to dealing with the issue about intra-group trading and the consolidated statement of financial position, we are going to be calculating provision for unrealized profit on the goods outstanding at the end of the year. But you have to also understand what is happening here in that case, because sometimes it can be the issue where we are talking about goods in transit. If the entity has some goods in stock and still there are some goods in transit, then the provision for realized profit would have to be computed on both the goods they have outstanding as well as the goods in transit. So that's the first part. Then still in the statement of financial position, there could be discrepancy between the trade receivables in the books of the parent and then the trade payables in the books of the subsidiary. Remember, I am assuming that parent is selling to the sub in that case. So if there are discrepancies on the consolidated financial statements, we need to cancel it, because you are not supposed to owe me, I'm not supposed to owe you, because we are now preparing the financial statement for a single entity. So for that reason, how much is outstanding in the books of the subsidiary, which is going to be trade payables, on the consolidated statement of financial position, when we bring the trade payable, we bring the parent, we bring the sub, we need to subtract how much is outstanding in the subsidiaries books as trade payables owing to the parent company. Then when we come to the trade receivables, we bring the parent and the sub, we need to subtract how much the parent also has in its books in relation to how much is receivable from the subsidiary in that case. Then there are times when I've mentioned goods in transit already. Like I said, we force it into the account of the person who is supposed to receive it, and then we will compute the provision for realized profit on it. Sometimes there could be also cash in transit. So if there is a cash in transit, we still push it into the account of the person supposed to receive it. And so when we write the cash or bank, we bring the parent, we bring the subsidiary, we add the cash in transit. Inventory, we bring the parent, we bring the sub, we add the goods in transit, then we subtract the provision for unrealized profit. Remember, the provision for unrealized profit will be computed on both the goods outstanding at the end of the year as well as any goods in transit in that case. So if you are preparing the consolidated statement of financial position, this is how we deal with the intergroup trading. But if we are preparing the consolidated statement of profit or loss, then the treatment is going to be different. Number one, the total sales for the period that occurred between the parent and the sub, the total sales will have to be reversed both from the revenue and from the cost of sales. So the total sales that occurred in the post-acquisition period will be deducted from the revenue. So we will debit revenue and we will deduct it from the cost of sales. We credit the cost of sales with the total revenue. Then any provision for unrealized profit will be added to cost of sales, because the double entry for provision for realized profit is to debit cost of sales or debit the group retained earnings and then credit the issue in relation to the inventory in that case. So if we are dealing with the income statement also, this is how we go about it. Finally, back to the statement of financial position, the treatment of the provision for unrealized profit. If the parent is the one selling to the sub, then the provision for realized profit goes to the group retained earnings. But if the sub is selling to the parent, then the provision for realized profit will be deducted from the subsidiary's post-acquisition profit for the year. So this is how we deal with intergroup trading Kelvin. Does it make sense? Let me know if it makes sense, if you understand. Then Olakunle said the one that is relating to capital asset. Oh, okay, so you're referring to capital asset module here. Whoa, so that is a different thing altogether. I was thinking about Rick's money. That is why I needed a clarity on that so I can talk about it. This will be purely a writing aspect for me, especially because when it comes to the capital asset pricing module, we are bringing the risk-free rate plus the equity beta, and then we bring the return on the market minus the risk-free rate, or the return on the market minus the risk-free rate can also be the equity risk premium. Now, the beta that we are bringing there, it's the equity beta. But there are some times when the examiner will give us an asset beta, or the company is diversifying and we have to take into consideration the risks. So we need to calculate the asset beta of a proxy company or of an industry and region in that case. So Olakunle, this is what I would do in relation to this. I have to write and illustrate to you. So I'm going to add this to the things that I will discuss possibly tomorrow with you guys, as I will be able to write. Then I can illustrate this to you and explain it for you better. Because we need to use the formula and then read here, taking into consideration the risks, and calculate a new capital asset pricing module, which will be used to appraise a project. And normally this risk aspect comes in if the entity is diversifying. So an educational institute going into banking, we cannot appraise that new investment using our current capital asset pricing or our current cost of equity. We need to take into consideration the risk that is in the banking industry. And the risk that is in the banking industry is the asset beta. So once we have the asset beta for that industry, we will use that to read here to calculate our new equity beta. And that new equity beta will now be used to calculate a new capital asset pricing module, which is the same as the cost of equity, and that will now be used to appraise the new project that we are going into. So basically, that is the idea in that case. But still, my video on the channel, in the playlist I showed you, I mentioned fundamentals in financial management. Sorry, understanding financial management. That is the playlist. You can look at cost of capital and then investment appraisal. I covered those things there. So you can look at that even before I have an opportunity to discuss it with you. Kelvin Kamara says, it does. Thank you, sir. You are welcome, Kelvin. If you join the stream, you give us a thumbs up on the video, right? So that we get more engagement. And in case you've not subscribed, I don't know why you've not subscribed, but you've got to subscribe to the channel, right? So, Essa Salah said, can you please shed light on credit losses? Thank you. When you say credit losses, what does it mean? Like credit losses in terms of what? Can you clarify it for me? Essa, if you are still online, you can clarify your question for me, then I can answer you better, okay? Aisha said, when you calculating ROI, how do you know what not to include in the net investment? How do you know what the manager can't control? Okay, that's an excellent question in management accounting when evaluating or doing divisional performance evaluation. Usually, The examiner will state it in the question what the head office does and what the division also does. So there will be clarity, there will be something in the question that will tell you that these assets or these expenses are incurred by the head office and they have apportioned it to the division. So in that case, we will take it out from the division, or these assets are controlled by the head office, not by the division, and so we will take it out. So there will always be a clue, Aisha, in the question in relation to how the net investment will be calculated in that case. So there will always be a clue. So you have to look for the clue, what the examiner says the head office owes, and then what the division actually, what the head office owns and what the division actually control in that case. So Aisha, there is always a clue in the question for us to determine what the entity controls and what they don't control. And not only about the net investment, it's also about the issue in relation to determining the profit for the division, because you have to look at the controllable profit. So in that case, any expenses that has been incurred by the head office, which is apportioned to the division, must be eliminated and added back to the profit of the division in that case. So there will always be a clue, Aisha, in the question for us to determine what the entity controls and what the entity does not control. There is not a golden rule. Okay, management accounting, there is not a golden rule for us to say this, but the question will always have a clue on what the entity control and what the entity does not control. I hope that makes sense for you, Aisha. So Olakunle said thank you, sir. All right. So Salah Essa said, loss allowance, that is credit loss, expected credit loss, lifetime credit loss. Okay, so your question was, can you share more light on credit losses? Then your clarifier is loss allowances, that is credit loss, expected credit loss, lifetime credit losses, and 12-month expected losses. Oh, okay. Now, I need another clarification, all right, so that I can answer you better. But let me put in some things here as you see if it makes sense. If it doesn't, then you provide me with some more clarity on it. According to IAS, if asking this question in terms of financial reporting, then according to IAS 37, okay, so if it is about financial reporting, let me know. If it's not about financial reporting, let me know. If it's another thing, let me know about it. But according to IAS 37, an entity cannot provide for future losses. Future operating losses, you cannot recognize it. You cannot provide for it. So that it is against the standards, because IAS 37 states that for us to provide, there has to be a present obligation. But if there is a future operating losses, there is no present obligation, and hence we cannot provide for it in that case. However, any loss that has been incurred currently, okay, for the period under consideration, like impairment is a loss, then those kind of losses could be recognized in the books in that case. So if any expected future loss cannot be recognized, cannot be treated, it is against IAS 37. It is just the loss that we have actually incurred for the year under consideration that could be accounted for and provided for in the books. Okay, so Salah said, is the new P2, which is, okay, so I get it there. Okay, yeah, so that is it about that. It's against the IAS 37, like I mentioned, for us to provide for any future expected losses. You cannot do that. but only the losses that you have incurred for the year, impairment losses and other losses that you can provide for. But any future expected losses, you cannot provide for it in that case. Does it make sense? Any other questions for me? Okay, so Esa Sela said, yes, sir. Thank you. You are welcome. So any other questions for me? Any other questions for me? Put them in the chat box. Right, so as you're preparing for the exams and working hard on yourself in what you need to do, most of you will be writing your exams. I think those from Nigeria writing the ICAG. Immediately after your lockdown, you have your exams. Ghana, we have our exams, ICAG, and that is going to be around 13th of July. And then ACC is going to also be the first week in July, in that case. Erisa said, overview on IPSAS 9. What is IPSAS 9? I've forgotten IPSAS 9. Let me cross-check IPSAS 9, the code. That is revenue from exchange transactions. Okay. Now, IPSAS 9 is equivalent or based on IAS 18 revenue. So we need to distinguish between now when it comes to revenue recognition in public sector under the IPSAS, there are two standards that talks about that. The IPSAS 9 is the revenue from exchange transactions, and I think IPSAS 23 is about revenue from non-exchange transactions. Let me look at that so I don't give you bomb. Let's see. Yes, so IPSAS 23, it's revenue from non-exchange transaction, but you are asking IPSAS 9, so let's go there. So what is an exchange transaction and what is a non-exchange transaction? So basically, an exchange transaction is a transaction where an entity receives a consideration or revenue and do something in exchange for it. So either transferring goods or rendering service, that is an exchange transaction. But a non-exchange transaction is where the entity receives a consideration or receives a benefit without doing anything in return. So let's give some examples of a non-exchange transaction. So let's say a grant received by the department, by the entity, the government will not do anything. The entity will not do anything to the other party that brought the grant. So that is a revenue from what? A non-exchange transaction, or a car donation or a cash donation. You won't do anything in return. So you'll be going to be recognizing for those items in accordance with what? IAS 23. But let's come to your question about IPSAS 9. The IPSAS 9, since it is based on IAS 18, there are, I think, 3 items that we need to look out for in relation to that. I think we need to look out for revenue from goods, the sale of goods, revenue from rendering of services, and then revenue from interest, royalties, and those things. These are the 3 classifications of exchange, revenue from exchange transactions. The first one is goods. So if we are selling goods, typically, when do we actually recognize revenue? The standard states that we recognize the revenue if there has been transfer of ownership of the goods. So if I'm selling this water to you, now I'm not sponsored on this water though, but if I'm selling this water to you, at what point do I recognize the revenue? Once the transaction takes place and then I give you the goods, I can recognize the revenue in relation to that. So if there is a transfer of risks and rewards, then we can recognize the revenue. But if there had not been any transfer of risks and rewards, then we cannot recognize revenue. So about goods, that's how we deal with it in that case. Now, if the public sector entity is also dealing with services, at what point do we recognize the revenue? We recognize the revenue when the service is complete. Now, there are times when the service would have to be undertaken on the site of the customer. So, for instance, let's say that we are doing some consultancy services or survey services. So we are engaged and then we go and do the job until it is done and the customer is satisfied and we are complete. We cannot recognize revenue in that case. So that is also about services, and there are other deeper layers in this case, but I'm giving you just an overview so you get it there. Then the last one is revenue from the use of assets by other entities. So if I put my money in an investment account, the benefit I'm getting or royalties I receive from the usage of my asset or the usage of my property, that is also a form of revenue. So in this case, we are getting the revenue, but the entity is using our asset to generate profit, and so they give us some of a part of the cake or a part of the pie, so we can also enjoy in that case. So when it comes to ICAG 9, generally, this is the overview of ICAG 9. It's classified into three. You must understand what is an exchange transaction, what is a non-exchange transaction, and then goods, when we can recognize, services, when we can recognize, and then interest, when we can recognize. Now, when it comes to interest, dividends, and royalties, it is recognized when it becomes receivable, not when it is declared really, but when it becomes what? Receivable. So if it is done that, okay, you are going to be receiving this, then we can recognize it in that case. So when it becomes receivable, then the entity can recognize it in its books in relation to that. So ERISA, this is what you have to understand about the overview about ICAG 9. Does it make sense? Do you understand it? Any other questions for me? Okay, so ERISA said, got it very well. Thanks, sir. All right, you're welcome. Any other questions for me? Any other questions for me? Right, so at this point that we have about 25, 28 days to go, you've got to be working hard. All right, you've got to be working hard. By this time, you should know the areas that you are strong in. And now you will be looking at the areas that you have deficiencies and then some weaknesses in that case. And for those of you who are preparing to attend all manner of intervention classes, go there with an objective and an open mind, knowing that you are going to be provided with an overview of everything that you need to know, but you need to also put in the work. Okay, it's not a magic pill. It's not about somebody sitting down and telling you that we never, this is what is coming, this is what is coming, this is what is coming. No, if you don't put in the effort, you're still going to fail the exams in that case. So go to those revision session, intervention, whatever it is, with an open mind if you're going to go on. But you need to sit down on your butt and study. It's very, very critical. You need to sit down and study, right? It's very critical. It's very critical because if you don't put in the work, you don't put in the effort, you don't sit down to study, whatever you go and listen to will be waste. And like I said earlier, for those of you who are waiting that 1 week to the exams, you will start working, you are actually setting yourself up for failure. I know somebody will say, oh, Nhyira, my friend said he used 1 week, no, brushed through, no, he went to the exam and go and went and passed the exams. That doesn't mean to work for you, okay? Some of those things are dumb statements, so don't listen to it. Because if you don't put in the work, if you don't put in the effort, yes, it can work for somebody, but you know, it's not going to work for you, all right? You're not exceptional. So it's not going to work for you in that case. But you need to put in the work, you need to put in the efforts, you need to put in the sacrifice in that case. That is why I try to come your way as much as possible so I can touch on the areas you have challenge in, on sports as we go ahead, on sports as we go ahead, on sport as we go ahead, so you can study. This is how you're going to understand. If by now you don't know what you don't know, like a favorite quote that says, he who knows not and does not know he knows not is a fool. All right? He who knows not and does not know he knows not is a fool. But he who knows not and knows he knows not is wise. So at this stage, you must know what you know and you must know what you don't know so that you can now start narrowing down, focusing, and working hard on yourself because it's critical. All right? So I want you to put in the work, I want you to put in the efforts, I want you to put in the sacrifice, because at the end of the day, that is what is going to take you to the next level. At the end of the day, that is going to assist you to become successful. At the end of the day, that is what you need in order to push your life to the next level. So please, don't sit down and say, I'm waiting 1 week to the exams, media, I work well. Some people, sometimes when I hear people saying a couple of things, I just laugh. Somebody will say, oh, when it is 3 days to exam, that is where my mind is active. And that time I can learn and everything will stay. You are doing baba. It is called babacious. All right? That's not an English word in the context of how I want to say it. You are doing baba, you are chewing baba. You are punishing yourself. All right? You punishing yourself. Put in the efforts now. I know some of you are giving a lot of excuses. My wife, my daughter, my children, my spouse, my work, my boss, my mother, my father, my boyfriend, my girlfriend, and all of those dumb statements. Stop giving yourself those excuses. All right? Put in the work. Put in the work. Put in the work. If you put in the work, you put in the efforts, you put in the sacrifice, I can guarantee you will smile. Sometimes you go to the exam hall, there is an air condition on, and like someone sitting beside the air condition but still sweating profusely. Why? Because you're freaking out in the exam hall. Why should you be freaking out in the exam hall? Right? And there are people who go to the exam hall, write the exams, and they know that I'll be back next semester because I'll fail. And the results will come to fail. But they won't learn. They will still be there 1 week to the exams, then they will pick their books. You see, when you do that, you are prolonging and wasting your life. Because you see, you can make money back, but you cannot make time back. That is one thing that you must understand in that case. You can make money back, but you cannot make time back. So that is something you must understand. So take note of that, work hard. I see a comment, let me read that and discuss about that. If you have any questions in the chat box for me. Patrick Mens said, hi Nhyira, can you briefly explain total cash emolument and what's not included? Whoa, that's a broad thing, right? That's a broad thing. Now, Patrick, I will give you a guideline, but I would want you to watch a video as well on my channel. There is a playlist on my channel titled Taxation and Fiscal Policy in Ghana. That is the name of the playlist, Taxation and Fiscal Policy in Ghana. As of now, there are 14 videos in that playlist. After I answer you and after the stream, go to that playlist, and there is a lecture video there titled How Chargeable Income. I gave a breakdown on the pro forma on how you calculate the chargeable income. So that video is a two-part video. Make time, watch those two-part videos, and you will understand everything about how you compute the chargeable income. All right, but I'm going to give you some tips here. But like I said, go and watch those two-part videos on the channel to be able to understand. Now, in computing your total cash emoluments, definitely you're going to be coming with your basic salary. You bring your cash allowances, risk allowances, then other indirect payments like the second tier payment, 13% of your basic salary which the employer is going to be paying, we will add it. If the employer still makes any payment in relation to our provident fund, which is the third tier, that will also be added in that case. Then we will be able to come and get our total cash emolument in that case. So you bring your basic salary, you bring your cash allowances, then any indirect payment that the employer pays on our behalf, statutorily the second tier or the first tier, which is the 13% of the basic salary, that has to come there. And then any payment into the provident fund, which is the third tier that the employer pays, that is also coming there, and that gives you the total cash emolument. So if you ask Patrick, these are the things that are included generally in the total cash emolument. But like I said, check that playlist out, Taxation and Fiscal Policy in Ghana, and there is a two-part video on how to calculate chargeable income, and you can get that and understand the entire overview on calculating the chargeable income. I hope it makes sense. Any other questions for me? Okay, so Patrick said, awesome, thanks, I will check that out. Okay, that's great. So I think that I'll be ending here around here today for our discussion, and God willing will be coming tomorrow your way on the functional budget preparation, and as well we'll be answering any questions that you have. It's been interesting with the questions that we have. I'll be going live on Facebook as well in the next 5 minutes or so, to be able to I see a comment, Charles Zuli. Hi, on the study portal, no work example lecture notes on income tax liability. I don't understand what you are saying, no. Income tax liability on our portal, we've solved questions on that. And there are Zoom sessions also about income tax liabilities, and we've solved questions on that. And all of those questions have been shared on our WhatsApp platform. So if you're asking about those things, there are questions available about that. So I don't know where you are searching or where you are looking at though. But if you have any issue, you can WhatsApp the line, and then that issue will be dealt with. But in the best of my knowledge, we have lecture videos on income tax liabilities, calculation and questions, and the questions have been given out to the students and available to them. So I don't know where you are looking at though, but if you have any issue, you can WhatsApp the line, and then the issue can be dealt with. Right, so I will end here today. Thank you very much for joining the stream. Victor, MCA, Samuel Kwasin, Laura, Patience, Nana Apia, Kubi, Kwame Kane, Erisa, Zola, Seidu, Ebenezer, Arthur, Mohammed, Isifu, Alpha, Kenny One, Olakunle, Kelvin Kamara, Aisha, Patrick, Charles, everybody, thank you very much for joining the stream. It's always a pleasure coming your way and to share my thoughts with you and also answer any questions that you are having. So I'll be coming your way same time tomorrow, 4:30 p.m. hoping that we'll be able to fix our issues, and definitely we will go to the preparation of the functional budget, solve a question on the functional budget, and find out how we can actually prepare the functional budget. And again, I will as well be answering your questions for you. You can join me on Facebook in the next 5 or 10 minutes if you have any questions there. I'll be having a short Q&A session on Facebook as well right now to answer any questions that you have as well. So thank you very much. I'll see you same time tomorrow. Thank you, and you take care.